So I'll just I'll watch that list here. But so we're going to go through today, basically going to go through some of the housing values, what's happening with housing values. You guys, a lot of people on the call are real estate agents, and you guys might know better even than I do about the housing and what's happening with values at this point in time. But I'm going to go back to 2007 and 2008 and show you how that's a little different than today's market, and why I think the values are going to be where they are over the next year. And then we're going to touch base on mortgage rates as well, the second half, and kind of go over why they are where they're at right now, and where I think they're going to be in 2023. So what are those things that are driving the interest rates, and when they're actually going to go down? All right, so let's get this going here. So the second half of last year kind of took us all by surprise, and really the market was driven by mortgage rates, and because of inflation, the interest rates went up, and the housing market has kind of come to a little bit of a standstill at this point in time. So, but housing is a huge driver of the economy, and it's going to have a big impact. So let me give you a little bit of a history lesson from basically back towards 2005, actually, when we had our housing bubble. And so during the housing bubble, we had a ton of equity, and this yellow line kind of shows you how much equity we had in our homes at that point in time. And then in 2007 and 2008, it actually fell apart, and you can see that the debt was actually exceeding the values of homes, and we had a ton of foreclosures, and the values went down further and further, and it was kind of a snowball effect. Well, in 2008, the government took over Fannie Mae and Freddie Mac because they were just bleeding with all these foreclosures and issues and debt, and they were in trouble as well. So the government took control of Fannie Mae and Freddie Mac in 2008. We move into 2010. That's when Dodd-Frank was introduced into Wall Street, and basically they made some pretty significant changes to the financial system. They tightened credit standards, increased the disclosures, and all of this right in the middle of the foreclosures and kind of the housing bust at this point in time. And so these changes were pretty significant and had an impact actually going forward over time here. Fast forward to 2014, and that's when we really started to see from our side as a lender, some of the underwriting standards were kind of put in place so that borrowers could repay their mortgages, whereas the no doc, 100% financing, you're just breathing type of a borrower, those guidelines were gone. And so we started to get tighten up the underwriting guidelines, lower the debt to income ratios, increase the credit scores, all of those things. And as you can see, some of those things, they started to change and had an effect on us in the market and the values of properties. And so all these changes that we made had a big impact. Fast forward to the pandemic in 2020. And when we hit the pandemic in 2020, the values went way up because the interest rates came down. So there was a lot of people that wanted houses. There wasn't enough supply. And in addition to that, the government basically told all the servicers that they did not want them to foreclose on properties at that point in time, right in the middle of the pandemic. And that helped values stay strong during that time because we weren't foreclosing on people. And the standard, those modifications or agreements that the servicers made kept people in their houses rather than having to have them sell their house either, right away or at a loss or what have you. And so that they kept them in the houses, and they kept people actually making their mortgage payments, but it had a big impact on what we're going to see now. So the other thing that we've done with the credit standards is, I'm going to show you this. It's the credit scores of borrowers over time. And so this goes back to 2003-ish. And if you look in 2003 to 2005, 6, 7, you can see that under people with credit scores under 720 was about 40 to 45%, even higher in some instances, of the borrowers that we were giving loans to. If you look at under 660 credit scores, they were like 20 to 25% of the borrowers that we were giving loans to. And if you fast forward to 2020 and even into today's world, you can see that the borrowers that we're giving loans to that are under 720 is actually less than or right around 20%. So you can see that the standards that we've had, the loans that we're giving, the quality of the borrowers is actually going up. So rather than being at 45% of them under 720, we're seeing them at 20%, or even if they're under 660, we're doing less than 7% of the loans under a 660 credit score. So again, just kind of telling you that the quality of the borrowers has gone up significantly over the years. Now, some of the propaganda, some of the media that's out there is showing us that foreclosures are going up in this current market. This is actually from July of 2022, so it's a bit dated, but this is you're hearing this feedback. And while this is actually true, from 2021 to 2022, the foreclosures are up 150%. But when you go back and look at the data, it is way down from 2008, 9, 10, 11. There were 1.3, 1.5, 1.6, 1.1, and even 1 million in 2012. And so during that time, there was a lot of foreclosures. We had a lot of impact on the values of houses. But if you compare that to today's market, we're like really at all-time lows for foreclosures at this point in time. And I throw this in here because there's a lot of equity in houses. So people are not going to get foreclosed on their house. They're probably, if they're in trouble, they're probably going to sell their house because they have at least 50% equity in their house. So nationwide, these are some of the numbers that, we're over 50% equity in houses right now. And so we're not going to see a lot of foreclosures going forward in 2023. Yes, you're going to have more because there's going to be a recession and there's going to be people that can't afford their houses anymore. Maybe people that bought over even the last 6 to 9 months at the higher values, and they may go into negative equity position. Probably not, but they may have some troubles and they might have to foreclose on their house, but it's going to be limited. We are going to see some. It's not going to be as big as it was in 2007 and 2008. We are going into a recession. And so I do see that is going to be, happening. And I'll show you the signs of those a little bit later in the presentation. But housing generally stays strong through the recessions. The only time where we've seen it out of the last 9 times that we've had a recession. So these vertical lines that you see are all recessions. Over those recessionary periods, you see the values of houses have stayed pretty strong. And that's because generally interest rates go down during those recessionary periods. The only time was in 2007, 2008. And that's where we had a glut of housing, a lot of extra houses out there. The builders were continuing to build, and I'll go over that in a little bit further here. But that's where we saw the housing prices decline. So 8 out of the last 9 times, we've seen housing stay very, very strong through the recessions. Continuing with that thought is these are birth rates over the last since 1928. And you can see that this, where it says 33 years earlier, that means that was in the mid 1970s. And so those people that were born in the 70s were buying houses in 2004, 5, 6, 7. And so you can see that there was a drop in the population or drop in the birth rates. And so I'll show you again just how the builders were, the housing formations and number of houses that were being built, and show you a little bit of how that impacted the values. But you can see going forward that the birth rates, so the millennials and the post-millennials, the birth rates have been very, very strong. And so there's a lot of demand for these guys that are the millennials, post-millennials to buy houses. And so the demand is going to be high over time here. And we just have to make sure that the builders are building enough homes to keep up with those birth rates. So I know this kind of goes back a long ways, but it does have an impact going forward with the values. So the growth, let me show you this graph here. And basically the blue lines are the household growth. And that's the number of kind of housing formations there as far as people are concerned. And then the orange is the actual annual completions of houses. And so you can see back in 2006, 2007, the household formations actually went way, way down. So there's a huge drop in formations. And during this time with the housing crisis, the builders actually kept on building homes. And so you can see that the completions were the most in the history, okay? So they kept on building homes, and they still kept on building homes 07, 08, and they finally started to back off, and the formations were stayed way, way, way down. Well, if you fast forward to today, the housing formations are actually up. So that means that the population growth is having an impact. There's more households being formulated, but the builders have not been able to keep up with the supply and or the inventory to keep up with those housing formations. In fact, during the pandemic, because of just the supply chain and so forth, they couldn't build enough houses to keep up with the demand that was out there. And so that was a little bit of an issue, but we still have a birth rate issue that they're dealing with. And so again, the supply and demand thing starts to come into play, where there's a lot more formations coming than there are actually houses being built. So to kind of keep on with that thought, we've been kind of moving along at about a rate of 1.7 million homes or household formations until the rates hit 7%. Once the rates hit 7%, those formations started to come down. More and more people started living together. More families were staying together rather than going out and renting or actually buying, buying new houses. And so that's come down a little bit, but basically, the demand, there's still a pent up demand of people that want to buy houses. So if the interest rates do come down, then you're going to see this 1.3 million actually go up and get back up into the $1.7 million or 1.7 household formations created over a yearly period. And so what we see right now is the housing starts, the completions are at 1.5 million. There's about 100,000 units that are destroyed every single year. And so the total new supply is about 1.4 million formations. And I'm sorry, is the total new supply is 1.4 million and the formations are at 1.3. So if you go back to the last slide, it shows you the 1.3 million. If the rates do go down, this formation is going to go up. So the builders are barely keeping up with the amount of supply for the new formations that are coming. Now, the other thing is that the builders learned their lesson from 2005, 6, and 7, and 8. And so you can see here that I put a graph in that the housing permits are actually way, way down. So they are, the number of permits have come down significantly. So we're starting to see the builders kind of back off the number of permits that are being asked for. And so they're starting, the builders are backing off on building new homes as well. So there's certain areas that it may be growing, but overall, from a nationwide perspective, the permits are way down from where they were even at the beginning of 2022. So we're still going to have a supply and demand issue with the number of houses that are being the number of houses that are being built. In addition to that, we have, this is just a recent headline that Chase and Wall Street are going to continue to buy homes. Institutional investors, companies, banks, etc., have decided to buy single-family homes for rentals. So $110 million has been allocated to purchase over 400,000 single-family homes across the United States. And those institutional investors, they already own about 700,000 homes, or 3% of the market at this point in time. And these are generally not multi-million-dollar homes. They're more like the $300,000 to $1 million range houses that are being purchased by these banks and institutional investors. And it's really, so it's taking market share away from the first-time home buyer. And it's really expected that by 2030, that these banks are going to own 40% of the residential market. So if your buyers are kind of waiting to buy, I think the banks have they may have a better handle on this and think that the real estate market is a good market to be in. And so they're buying. Once they start buying more and more, then the values are still going to stay strong and still going to be up there. And so what I'm saying here is I don't think that we're going to see the values go down in 2023. And in fact, these banks and institutional investors are going to keep the prices up. And with all of those factors that we just went through, I just don't see a crash coming in 2023. I don't see a bubble. I don't see values. Yes, they're going to come down. They've come off of their highs, and we're kind of sitting and waiting in this holding pattern. And we have seen some values, the values dip, but we also think that as interest rates come down, the demand is going to go right back up, and we're going to be right into the same spot where we were, with values being pushed up higher over the next few months here. So as interest rates come down, the housing market will continue to stay strong. We may see even multiple offers again on houses with the lower interest rates. Wanted to show you this just to kind of go through as far as everybody else where they think the market is concerned. And I think it's a little bit of a 50-50 spot here, but Realtor.com, Zillow, NAR, Freddie Mac, Fannie Mae, Mortgage Bankers Association, Redfin, here's all of their predictions, their most recent predictions. And so Realtor.com, they're the most excited about the market. They think it's going to go up over 5%. We think that it's going to be flat to a low 1%, 2% gain over the next year. So we're kind of right in the middle of all these guys and basically saying that it's going to be pretty flat this year. Nobody predicts a huge drop in the market. The only one there, Redfin, is down 4%, and that is not a huge deal at all. So with lower inflation and lower mortgage rates, a recession coming, incomes are increasing to help the affordability, and a very tight inventory, we think that this is still going to be a strong market for the values are going to stay pretty strong for 2023. So as we transition out of that into the rates, the interest rates are driving the real estate market. They always have, and they always will. And inflation actually drives the mortgage rates. So I'm going to give you a little bit of a background and go through the inflation and how that impacts rates. It's going to be real quick here, and it's not going to be long, but it'll tell you a little bit about kind of where the interest rates are headed. So just a real simple definition of inflation is there's too many dollars chasing after too few goods. And so we've seen that in the housing market over the last couple of years, and inflation is basically that we had a lot of dollars with low interest rate chasing after too few houses. So the inventory was low, and what happened was the values went up, and that's inflation. That is basically pushing those values up. If you've gone to the grocery store lately, then maybe another good example would be eggs. And so about a year ago, I think there was a flu, the bird flu with the chickens. And so we had a lot of birds die. And so with that, it created an inventory problem that we're seeing today. And there's not enough eggs that are being produced. And so a dozen eggs, it sounds like it's going for like $8 to $10 for a dozen of eggs, and that's not usually the case. It's up a huge amount, especially here in California. So that is inflation. It's too many dollars chasing after too few goods, a supply and demand issue, right? And so as we look at this from a mortgage perspective, the blue line here on this graph is our mortgage rates. And so the CPI number is the red line on the bottom. So that's inflation. And so as inflation goes up, so do mortgage rates. The only time that we didn't see this happen is during quantitative easing, when the Fed was actually buying mortgage-backed securities, they were buying treasuries, and they were artificially keeping the interest rates down during the pandemic time period. As you can see, the CPI, or the inflation, went way up right in the middle of that quantitative easing. Once they stopped buying, the government stopped buying the bonds and mortgage-backed securities, you can see that the interest rates went way up, and they went up with the inflation numbers. And eventually they got in over 7%. Right? And then we've seen inflation drop as of late. And so the inflation numbers came down, so do the interest rates. So they've come down a little bit over the last couple of months, but that's showing you that inflation actually drives where mortgage rates are headed. And so just to kind of give you even a little bit further of a history lesson on the mortgage rates, let me see here, admit. These are month over month inflation numbers. And so this is measured from August of 2021, and it goes all the way through actually this morning's readings of the CPI. And this is the trend line of where inflation is headed. So we've seen the peak of where the inflation is, and we're starting to see the mortgage rates come down. The supply chain is getting resolved. Inventories at retail stores are actually going up. And the impact of what the Fed has done in increasing the Fed funds rate has slowed down the economy and has then slowed down the inflation numbers. So when we take a look at this, the way that they calculate it is on a 12-month period of time. And so these numbers that are over here are no longer in the inflation numbers, right? So they look at the last 12 months of inflation numbers month over month. And they do a compilation of that, and then they get the actual core CPI numbers. But basically what we're doing, like today, it came in at negative 0.1% month over month. So that shows that prices are coming down of goods and services. It replaced a 0.6% number from December of 2021. And so now, once you move forward, and what the Fed is doing to lower the inflation is increasing the Fed funds rate. And once you see, like, this line is going down and it's going to continue to go down, because of those changes, it's going to be replacing another 0.6, 0.5. In March, it's only going to replace a 0.3%, but then you're going to replace all this 0.6, 0.6, 0.7, all with lower month over month numbers in the CPI. So you're going to start as this red box moves further off to the right-hand side with lower numbers, you're going to replace these higher numbers with the lower numbers, and the CPI is going to come down. So that's kind of the basic math of how the inflation is working and how the Fed is moving towards getting the inflation numbers down. And as an example of this, the bond market, on November 10th, the CPI came out, or inflation numbers, and it came out at 7.8% versus the projected at 8%. So they thought it was going to come down to 8%. It actually came down to 7.8%, which is still high on the inflation numbers, but the market likes these numbers moving forward. And so what happened was a huge price increase in the market. So the bond prices went up and the yield actually came down. You can see that this is a movement, one-day movement in the market. All the rest of the days are very small movements here. This was based on inflation numbers that came out, and the market rallied, and interest rates came down 1/4 to 3/8 of a point just in that one day, because they saw the impact of what the Fed was doing and how the interest rates were actually they're going to come down as a result of that. So the yield dropped from 4.1% to 3.8%, and that's where we started to see the improvement in the mortgage rates. So as we kind of go through and start to see the inflation drop more and more, the bond market will like this, and you will watch the yield continue to drop over time. The one thing that's kind of holding it back right now is shelter costs. And the shelter cost is a lagging indicator. So if you went to the store and bought goods and services from the store, the pricing of those goods and services, they actually change very rapidly from month to month. So it's not rapidly, but they can change from month to month. When you're looking at shelter costs, you're looking at rentals. Rentals don't change for, sometimes there's a 12-month or a 2-year contract or lease agreement, and that takes time to get out of those lease agreements. So it's a little longer period to measure this. And so as you can see, this is the apartment list nationwide and the year-over-year changes on those rents. And so you can see that they've gone way up. And we'll go to the next spot here. The average of those that are included in the CPI, they average that out over year. And so when you take the average of that, it's still going up. This is 39% of the core CPI numbers, or inflation. And so this is a big piece of the inflation. So until we start to see these rents go down, we're not going to see a significant improvement in the inflation numbers. It's a little bit of a roller coaster, and it takes time for these things to come into play. And so let me go a little bit further here. Right now, this is January of 2022, and so the rents were up 18%, 17% year over year back in January, and they've started to come back down, but it is still not impacted in the CPI numbers. So we kind of look at it as a roller coaster. So if you're going up on the roller coaster, you keep on going up and up and up and up, and half of the roller coaster is on the downward slide and the other half is still on the upward side. That's how we look at the shelter costs and how how it kind of impacts the inflation numbers or impacts CPI. And so once these guys get to the top of the ride, then you'll start to see that the impact of the lower rents. Now, today, with the inflation numbers that came out this morning, which were down again, but they weren't down as much as we would have liked them to. The biggest indicator in there that kept them up was the shelter cost. The shelter costs went up again. And so I've been talking to real estate agents out there, and half of them have been saying, yeah, I see rents coming down, and half of them are saying the rents are still going up, and I still see a lack of inventory. So I think we're starting to see that. Last month, the shelter costs came down. I'm sorry, 2 months ago, the shelter costs came down. This month, they actually went up again. So we're kind of right in the middle. Until we start to see these shelter costs come down, we're not going to see inflation come down further. And so we want to see those rents come down, or at least stay stable there. The other thing that we have is the difference in the mortgage rates versus the 10-year treasury, or the yield on the 10-year treasury. And normally what we see is a 175 to 200 basis points, these red lines between the yield on the 10-year treasury and mortgage rates. So over time, that's been very, very consistent. And you can see that as of 30, 60 days ago, the spread was 300 basis points. So the yield was 4% on the treasury, and mortgage rates were at 7%. And I'm not going to go into a lot of detail on this, but basically servicers are not paying as much for these loans, because these loans are not going to stay on their books long enough, because they think that they're going to be refinanced within the next 6 to 12 months at lower interest rates. So when a servicer actually buys a loan and services that, so whoever you're making your mortgage payment to, there's a servicer, they take your payments in, they actually are a part of the mortgage rates, and they pay for that servicing to kind of do that. That's part of their business. But what they do is they think that those loans are going to stay on their books for 5, 6, 7 years. And that's how they make their money over time, is for those loans to stay on their books over time. Well, with rates at 7% and a knowledge that they think that interest rates are going to come down, they aren't paying anything for those loans. And so the spread moved up to 300 basis points. It's starting to come down. As interest rates come down, you will start to see them pay more for the servicing. And so when they pay more for the servicing, then the interest rates will come down even further. And over time, what I'm going to show you is these red circles here is where the yield on the 10-year treasury was at 3%. So there's 1, 2, 3, 4, 5, 6, 7 times that it's been at 3%, and mortgage rates were at or below 5%. Okay, so once that yield hits 3%, then the mortgage rates will look more like in the 4.5% to 5% range. Okay, hopefully that made sense to a lot of you. The recession is coming, and employment numbers are having an impact on kind of where we stand. So let me go through this real quickly here again. The Fed hikes, they actually lead to recessions. Those are the vertical dark lines in here are the recessions. So each one of those vertical lines shows a recession. During those recessions, the mortgage rates actually come down. And so this is true from this is 1950s back over here. I'm sorry, 1980s back over here. And you can see the impact of going into a recession and where mortgage rates go. So we think that there's a lot of factors that are showing us that we're going to go into a recession over in the next, 3, 6 to 9 months here. And so another few of those indicators are credit cards. The credit card debt, you can see this is from 2018. The credit card debt was going way up. We hit the recession, we hit the pandemic, and actually The credit card debt went down during the pandemic or right after the pandemic because people were shopping less. There wasn't inventory. They may have lost their job or lost their income at that point in time. And so the credit card debt actually went down during that period of time. And now, as you can see, after the pandemic, it has gone way, way up. And because of the Fed increasing the Fed funds rate, credit card rates they can be up as high as 28% on your credit cards. And so you can see this line. This is the usage of your debt and your credit card. It's going way, way up. Now, the other thing that's happening is the savings rates are actually going down. So during the pandemic, we had a pretty nice increase in the savings rates. It started to go down after the pandemic. And then we had stimulus package 1, the savings rate went up. And then we had stimulus package 2, the savings rate went up. But now after the stimulus package, the savings rates are going down. So these are the credit card debt, savings rates. These are another 2 indicators that we are most likely headed for some type of recession at this point in time. One other item here is that we have an inverted yield curve. And I know this gets a little bit complicated, but basically, if you were to put your money into a bond, a 3-month bond, I'm going to pay you less money for that generally because it's a shorter period of time. But if you gave me that money for 10 years, I would generally pay you more because you're giving it to me for 10 years. And so I'm going to pay you more for that. Well, that's a normal market. Right now, the 3-year yields on a 3-month yields on a treasury are paying more than a 10-year. So a 3-month yield is actually paying higher. And so what you can see here, once they go negative, which is right here, 1, 2, 3, 4 times, and we're now in the 5th time. Right after that is generally a recessionary period. So we go into a recession when we hit a negative or an inverted yield curve. And so these are showing us that we're going to go into a recession. Not to worry, the housing market generally stays pretty strong during the recession, but we will have some type of recession going forward. A recession does mean lower interest rates. Now, some of you are going to say, well, how can we go into a recession when we have a 3.5% unemployment rate? And that's what the Fed had been saying, right? Well, the way that we look at it, and we've gone back and done the data from 1950, again, the vertical lines are recessions. Every time we go into a recession, right before we go into a recession, we are at the full employment for that period of time. So these low numbers, this is unemployment numbers, goes down, and then right when before you go into a recession, and then you go into recession, the unemployment numbers go up. So watch these numbers, watch the unemployment numbers, watch the jobless claims and the continuing jobless claims. So people, even though the unemployment numbers actually went down, so went down from 3.7 to 3.5% in December, when we look at those numbers and dig a little deeper, it was all part-time employees that were hired in December. And so that was a seasonal thing. And we're starting to see the participation rate is still very low as far as people being employed in the just being employed at all. And then we see the jobless claims, you know, it's kind of they're going up, and they're kind of they've peaked. The jobless claims are continuing to go up. The continuing claims, so the people that have lost their jobs, those people are having a hard time finding new jobs as well. And so watch for those numbers, because we start to see this is the trend for 2021 and 2022. And you can start to see that we were at full employment. There was a lot of jobs that were created. after the pandemic, but you can start to see the trend is going down further and further here. And this is further kind of backed up by some of the headlines that are out there. Amazon is pausing corporate hiring. They actually are starting to lay off more and more people. A lot of people. Lyft, Salesforce, Snap, Meta, all of them, all of the those companies are laying off people. And so they're reducing their staff, and they're going into this recessionary period just kind of as a wait and see, and kind of getting their act together before they go into this recession. But you'll start to see more and more layoffs. Watch that number, watch the unemployment rate, watch the jobless claims going forward. The higher those go, the recession is coming. Interest rates will come down further as a result of it. Now, affordability. So you're trying to see, like, how do we figure out this affordability issue? And if people are getting laid off, then what's happening to our salaries? Well, there's the people that are not getting laid off. Their incomes, as long as they're not in the not a realtor or not in the mortgage business, those incomes are actually going up. And so the affordability is still there even at these higher prices. So let's take a look at just an example of how we look at this. And this is a nationwide, this is not a California example, it's just a nationwide kind of example that I'd like you to take a look at. Last year, $400,000 loan amount, 3.5% rate, an $1,800 mortgage payment, and their income was at $9,000. Okay, so you go 1 year further into this year, or 2022. We had 10% appreciation, so the values went up to 440. The interest rates went from 3.5 to 6.25, and your payment actually went up by $900 to $2,700. But your income went up by 9% as well. So ADP's reports of kind of increases in salaries was about a 9% increase. It went up $810 per month. So overall, that's not too big of an issue right there. But once you throw in the other inflationary issues like gas, food, other services, then the spread got a little bit more. And so it makes it a little bit more unaffordable at this point in time. Well, the way that we see it actually going forward this year, and my slide, I should say this year, is 2023, the values are going to stay strong. The loan amounts are going to be right around the same. The interest rates are going to be at 5%, and your payment is going to be almost $2,300 to $2,400. And with the inflation coming down, it's probably going to be less. So gas actually has gone down, and some of the other services are starting to go down. So your affordability is actually going to go up. And if you get another increase of 5% in your salary, the income is going to go up to $10,300. And so what we see is we don't think that it is going to be an affordability issue for the buyers. We think that they're going to be out there and be able to purchase these houses with the lower interest rates. And even if they don't, we have these options here. That's a perfect opportunity for housing. And what I'm telling my clients at this point in time is, hey, it is a buyer's market. There are not as many multiple offers on houses. And so, in fact, the sellers are giving credits to help with either permanent or temporary buy downs. And with those temporary or permanent buy downs, that gives you, the buyer, the opportunity to buy a house today without as much competition, even at higher interest rates. And we like the 2-1 buy down or the 3-2-1 buy down. In fact, I have a buyer right now in contract, a 3-2-1 buy down, 6.125% note rate, and their first year is going to be making payments at 3.125. There's over a $14,000 credit to go towards that buy down from the seller. And so they have a 3.125 note rate. for the first 12 months, 4.125 for the second year, and then 5.125 for the third year. And so this helps it be a little bit affordable. Now, if interest rates do go down, we're going to refinance that borrower into a 5% rate. And whatever excess is left over in this buy down account, and we can go over that in more detail if you want to, but any excess can be used towards the costs of a refinance. And so these are really nice options for today's market with a little bit higher interest rates. So as far as 2023 is concerned for interest rates, we do see them dropping. It's going to be a bit of a bumpy ride from now until the second quarter, but we're going to see rates come down. They're going to go up a little bit. They're going to come down. So it's just going to be a slow ride down. But let me give you a few kind of estimates here. This is MBA, Mortgage Bankers Association. They think in 2023 that interest rates are going to be at 6.2 to 6.5, I'm sorry, 5.7, 5.5, and 5.4% at the end of 2023, and going into 2024, 5.1, 4.8. So it gets into the fours in 2024. So really good numbers as far as moving forward. I think that that is too slow. I think the Fed is going to go too far with the increases, and I think they've got about another 3/4 of a point to go in the increases, which will slow down the economy. It will slow it down so far that it's going to basically have a huge impact on, well, it'll bring down inflation for sure, but it's going to slow down so far that it's going to put us into the recession if it hasn't already. And in fact, just this week, one of the former Fed presidents said that the Fed made a mistake by not acting as quick as they should have when the inflation was going up, and they thought it was just transitory and it was just going to be here for a short period of time. And so the Fed knows they made a mistake. And so what they said is that they don't want to make another mistake going forward. And they want to make sure that they take care of the issue. And so they're going to increase the Fed funds rate high enough to make sure that they take care of this inflation. But as I look at that, I think, well, they made a mistake once. If they are going to go too far this time, isn't that also a mistake by going too far? So I don't agree with some of the things that he said, and I don't agree with what a lot of the things that the Fed is doing. But what's going to happen, and history repeats itself, is that they're going to go too far, and they're going to bring the economy down into a recession, and interest rates will be at 5% by the end or sometime during the second quarter of 2023, and the yield on the 10-year Treasury will be at 3% or below. So going back to the graph that I showed you with the spread, we think that the yield is going to be at 3%, and we think that mortgage rates are going to be at 2% above that, or at around 5%. Backing that up, we have some articles, if you wanted to go look at it, a CNBC article that says that the rates will be at 4.5% in 2023. So that's Fannie Mae that's saying that. But there's a lot of other reasons why we see that those rates dropping. So the headwinds that are still kind of looking ahead here as far as the interest rates are concerned is the global quantitative tightening. And what that means is the whole world is tightening. Everybody's increasing their rates, the Fed funds rate. So their version of their money, they're increasing their rates. They're slowing down their economies across the world. And those countries are not actually buying bonds in the United States. So the United States is, they come to the States, they buy the bonds. It's a safe bet here. And so a lot of people generally buy. Well, they're not buying as much right now. In addition to that, we have more debt that needs to be financed. So even though we've had a change of guard as far as the House is concerned, the spending is going to be slowed down a little bit on kind of, going forward, there's not going to be as much stimulus out there. And so there has been a lot of debt that needs to be financed. So the war in Ukraine, a lot of these other things that the House has kind of approved already, those things need to be financed. And so that's a little bit of a headwind. And if they continue to kind of have more stimulus out there, then that might be an issue that will slow us down a little bit. But as far as the tailwinds, inflation is kind of is coming down. The supply chain issues have gone away. The inventories are up at stores, so there's enough inventory, except for eggs right now. But the inventories are up, and so that's kind of behind us, the supply chain issues. In addition to that, what we talked about, the servicing values, that will start to come down and compress a little bit. That'll help interest rates. And the recession is likely coming right behind us. And so what we see is those rates declining during a recessionary period. So just a quick recap again, housing values, still low inventory right now. So the supply and demand issue is keeping the values up. The rates, as they come down, will drive demand further and keep those values up higher. And rents, they're still increasing right now. And so as long as those increase, I think there's going to be people that are out there looking to buy houses, and that will have an impact. Mortgage rates down to 5% the second quarter because of lower inflation, recession, and the increased value of mortgage servicing. So all of those things to say, I think we're going to see these lower interest rates, and it's coming in the next 6 months here. So hopefully we'll see some light at the end of the tunnel. Well, that is all I have.